ICICI ETF and CNBC-TV18 present Smartly Passive, unlocking the world of ETFs.
In current times, consumers are seeking easy investment solutions that offer better returns on their hard-earned money. With this in mind, CNBC-TV18 and ICICI ETFs present Smartly Passive, Unlocking the World of ETFs, an informative masterclass where top industry professionals share insights on the current financial landscape and how passive investment tools can be leveraged as a part of a portfolio. Passive investing, notably through exchange-traded funds or the ETFs, has emerged as a significant trend in India. And in this masterclass, we help you understand how ETFs can serve as a strong diversification in your strategy and your portfolio as well. As always, our industry experts will share their success mantras for prudent investing as well. Let me introduce them to you. Please welcome Gurmeet Chaddha, the Managing Partner and Chief Investment Officer at Complete Circle Wealth, and Chintan Haria, the Principal Investment Strategy at ICICI Prudential Asset Management Company Limited. And in this episode, we'll focus on the commodity ETFs. These funds invest in physical gold or silver and can help you diversify your portfolio. So let's take a deeper dive into these funds as well. But first up, gentlemen, thank you so much for joining in today. It's a very interesting topic, so we have to get going and try and understand more about this as well. Chintan, let me start with you. Thank you for joining us in the studio. And you know, there's so much attraction towards physical gold, physical assets, physical silver in the country. There's a growing attention towards digital assets as well when it comes to digital gold or digital silver as well. What's your view on this? Is that the way to go about investing in some of these commodities?
So let's look at the history. 20 years back, there was no gold ETF. So there was no option for investors to invest in, in the form of digital gold or in the form of gold ETF. 2 years back, there was no silver ETF. So now today, those options are there. And versus storing it physically, of course, it's easier to invest through ETF. So clearly, it's a long way to go. Physical silver and gold still has a lot of comfort in terms of how people perceive it. Of course, jewelry is one aspect. But in terms of investment avenues, I think more and more gold ETF and silver ETF would form part of everyone's portfolio. And from a financial investment standpoint, that's an easier way to go by, right? You do not really want to store large quantities of silver. It's difficult. And gold, of course, while we do want to store it physically and people want to have it, let's remember physical storage and gold ETF is equal because gold ETF is backed by physical gold. So effectively, you are buying physical gold, but in an easier form.
And you don't have to pay for the storage costs as well.
Yes, you do pay, but through a more institutionalized mechanism which reduces your cost, and you don't have to worry about security as well. And more importantly, the purity.
Okay, all right. So that is how we compare it with physical gold. Gurmeet, your take on this, the popularity that these digital assets are gaining. Do you like this particular segment as well?
Oh, absolutely. And as Chintan said, gives you purity, gives you the added advantage of flexibility like financial instruments. They are traded like any other stock on the cash segment of BSE, NSE. And 1 unit of ETF basically is, for example, in gold is the price of 1 gram of gold. So if gold is, let's say, trading at 72,000, for example, the price of 1 unit of gold ETF would be basically 1 gram, which is, let's say, 7,200. So it's convenient. It's and post budget, it's become tax friendly as well. So now, if you see the listed gold ETFs, they are flat taxed at 12.5% after 12 months. So safe, pure, no storage issues. Gold also doing very well in the portfolio. If you see last, for example, 30-year returns, equity is about 14.5, gold is about 13.5. And much lesser standard deviation. So if you see the maximum drawdown in gold, that's hardly 25% compared to, let's say, 55-60% in equity, which we saw in 2000. So, good asset class to be in. The kind of geopolitics and the world which is moving towards, a new order makes sense to, gives you hedging benefit, gives you returns, low volatility, and very convenient.
Oh, yes. And gold is everything that one can talk about in last couple of months, right? So, Gurmeet, coming back to you itself, just simplify it for our viewers. You spoke about how gold connects with an ETF, how they are priced. But what are commodity ETFs exactly? Other than gold, we have silver as well, other commodities. So how can one invest there through these funds?
So, commodity ETF is nothing but a passive vehicle which tracks the price of that particular commodity backed by physical commodity, right? So these are physical commodity backed. In India, we have physical ETFs. globally, it's more complex. You have synthetic ETFs also, but that's too complex. So you can invest in silver. There are agricultural commodities. There are ferrous, non-ferrous metals. But for the sake of simplicity and the sake of understanding, because commodity as a word is quite complex, India, for example, the easier is to do gold and silver. While gold we just discussed, silver, on the other hand, actually is both a precious metal. It's also called a white metal and an industrial metal. So silver is actually a function of two things. One is in terms of it being a precious metal, and it tracks industrial consumption. So silver would be very much like equity. It tracks manufacturing activity, mining activity, and that is why if you see the volatility in silver would be much higher versus the gold. So if I compare all three, as I said, last 30 years I'm talking about, 35 years, equity 14-15%, gold about 13, silver about 7.5-8%.
Okay, get that. And thank you for that differentiation that you explained very nicely as well. So that is how commodity ETFs work. Chintan, coming to you, because when we talk about gold, there's so many avenues now available. We have sovereign gold bonds, we have digital gold. How does it differ from, say, an ETF? And what are some of the advantages or, say, disadvantages as well if we invest in a gold and silver ETF versus the other avenues?
So if we look at clearly from a gold investment standpoint, sovereign gold bond, which started I think in 2015-16, have their advantages of having an yield of 2.5%, and post 8 years of holding period or on maturity, there is no taxation. So clearly that advantages are there, which have been given by the government for those who subscribe to it. And today, if we look at it in terms of the incremental investments or incremental sovereign gold bond issues, there are not many. But on the other hand, gold ETFs clearly have the advantage of you not having a limit in terms of how much you can invest. In sovereign gold bonds, there's a limit of 4 kgs per person per year. Apart from that, of course, as an asset allocation tool, if you want to trade in and trade out, gold ETFs and silver ETFs provide that much more liquidity. They are easier to probably enter and exit in larger quantities, because still the sovereign gold bonds, even though they are listed on the markets, they are not that liquid, and currently because of the scarcity premium, they are actually trading at a higher price than what they should be justified based on the international prices of gold. So there are pros and cons, of course, but the way we look at it is if you want to buy and hold, then obviously you can have both the options. But if you want to put it as part of an asset allocation strategy, then gold ETFs and silver ETF do have an edge. Physical gold, of course, in terms of jewelry, there are making costs, etc. So that is a completely different, and the touch and feel of gold is something which everyone likes, and so that cannot be replaced. But in terms of investment avenues, both sovereign gold bonds and gold ETFs work for investors. However, gold ETF does provide them with added advantage of no limitation on how much you can invest in that, plus the easy entry and exit in terms of the online on the exchange. You can trade them much more easily.
Indians love physical gold, but of course from an investment point of view, these are some of the avenues which would be available. So say when we are talking about investments, Chintan, what role would silver ETF and gold ETF play in the overall portfolio construction? Are these short-term bets that one can take, or does it have to be for a longer term where they can put in their portfolio?
So clearly, if we break it up, if you look at gold, for example, right, for the last 14 years, say 12 years, US markets have done so well that equities have basically taken limelight and the maximum amount of flows. Gold from 2011 till 2021 did not perform, and arguably it has just about come up to its 2011 levels in the international markets. So gold is now starting to get its flows in terms of international ETFs, but just look at the comparison. International ETFs in terms of equity ETFs have an AUM of almost $7 trillion. Gold ETFs are only about $240 billion. That's just 3% of the equity assets. Globally also, if we look at the comparison, total equity in terms of market cap globally is $100 trillion. Debt is $300 trillion and gold is only about $15 trillion based on the available gold that has been mined in the last 250 years. So clearly, gold has been the forgotten asset class despite it having a 5,000-year history of store of value. Of course, it has a lot to do with money printing leading to equity markets doing well, and I think a lot of money chasing that. But I think that will change as we move along and more volatility. And whenever there's volatility, whenever there is a little bit of panic in the markets, gold becomes an asset class of choice. So as a diversification tool, we are suggesting anywhere between 5 to 10%. Put it in gold today. You made a lot of money in equities, maybe book profits there, no harm in that. And have it in gold so that it gives you comfort. It may not have yield, of course, if you invest in gold ETFs, but it gives you the comfort and safe haven investing. And even if a little trickle from this $100 trillion move towards gold, you have it. Silver is a completely different story altogether. 4 consecutive years of deficit. This year the deficit is supposed to be the highest. And now today, unlike earlier, 20% of incremental demand annually in silver is coming from the newer asset classes like solar and
New energy,
5G, new energy. That is something which is causing silver demand to go up sharply while supply is stagnant. So 4 consecutive years of deficit in a commodity, there is a definite stretch in terms of the availability of physical silver. So we believe physical silver can, or rather silver ETFs can also be a part as a diversification tool. It won't do what gold does. So when markets actually are volatile, silver may show some volatility, but in terms of just the demand supply mechanics right now and the new age requirement of silver, we believe silver is a good addition to your portfolio. So gold plus silver around 15%. Earlier when we would have spoken, I would have said 10%, now just increased it to 15 because the outlook on equity is getting that much more volatile. And so it's better to have some safe haven asset like gold and silver where the demand is genuinely strong right now.
Very interesting, and the data just shows how much more headroom is available for investments here. Gurmeet, your take on this one, because we usually talk about gold as an investment, silver doesn't get spoken about so much, but as Chintan just pointed out, this has a bigger supply-demand gap, so to say, that we are seeing right now. What's your take?
Well, I think I endorse what he's saying. Also, we get so carried away with returns, we forget the 2 other aspects of asset allocation, which is low correlation and diversification, right? And gold has the least correlation with asset classes. It typically does well when there is a crisis. It did well in 2008 when Lehman happened. It did well during COVID period. It jumped up when you had a Russia-Ukraine war. Does well in a crisis. So it has that hedging benefit. We originally migrated from Pakistan. I remember my granddad used to tell me that, an ounce of gold is good enough to run you for a couple of months. It still holds true. An ounce of gold is about 28 grams. That's roughly about more than 2 lakh rupees. You can still survive, right? If you have an ounce of gold. So, it doesn't lose its purchasing power. And that's the point I think, even Chintan was making. Silver, as I said, it's if you track silver, it's a bet on the new age themes which are coming up and a broader revival of, manufacturing, mining, etc. So if you're gungo on, and the way, the geopolitical situations are evolving, supply chains are getting disrupted, hard assets will do well. And if you see, a weak dollar, if let's say the kind of debt US has, and now US will start cutting rates, we have a Fed meet today, a weak dollar traditionally is very good for commodities. So, the macro is in your favor. The gold gives you a power, protects your purchasing power plus returns. Silver gives you a play on the rising new themes and industrial activity. So perfect makes sense. 10% odd in your portfolio should be towards gold and silver.
Okay, so words of wisdom from your grandfather as well. It's been coming in from generations clearly. The love that Indians generally have for gold, but of course we have diversified the way we invest in gold as well right now. Gurmeet, just to follow up on that, now that we're talking about returns, usually that's what investors look at the end of the day. We have to talk about post-tax returns as well. What are some of the key tax implications on investing in, say, gold and silver ETFs, if we compare it to holding physical gold or silver?
Yeah, so physically, if you hold it, you have to hold it for 2 years for long-term capital gain, which is 12.5%. And obviously, if you hold it above a certain threshold, there are wealth tax implication, but that comes once you hold a very large quantity. In an ETF post the recent budget, because it becomes a listed financial asset technically, because the underlying is financial assets, an ETF on the exchange, the taxation is 12.5% after 12 months. So in terms of tenure, it's more efficient than physical gold. But if you, for example, take a gold, there's another option of gold ETF. Sometimes there can be liquidity issues for a retail guy. There could be a creation unit size issue. You can also take something called a gold savings fund, which is basically a fund of fund which invests into gold, where you can actually do an SIP also, you can do an STP also. So it offers you all the mutual fund convenience if you take a fund of fund route. So digital and physical gold are 2 years, 12.5% long-term capital gain. Gold ETF is 12.5% after 1 year old.
Okay, it's turning out to be a very interesting conversation. I'm learning so many new things about gold, silver, ETFs and generally that asset class. But we have to get into a quick break. It's time for a break. We'll continue this conversation right after this short break, so don't go anywhere.
ICICI ETF and CNBC-TV18 present Smartly Passive, Unlocking the World of ETFs. ICICI ETF and CNBC-TV18 present Smartly Passive, Unlocking the World of ETFs.
Welcome back. You're watching CNBC-TV18 and ICICI ETFs present Smartly Passive, Unlocking the World of ETFs. And we are diving back into our very interesting conversation. It's all about commodity ETFs. Chintan, let me come to you. You gave us this data and I'm really boggled by that till now gold and silver is such a small part of the overall ETF picture globally as well. So how do you see the role evolving in the next decade, especially with the growing interest in digital currencies? There are so many of them. Alternative assets have also come up. So what does the next decade look like here?
So I think the last decade was in general a decade of low inflation, low growth for the world. Arguably with US slowing down and likely to cut rates and China also wanting to prop up their economy. Maybe the prices of goods in China go up, prices of services in US go up, leads to inflationary pressures. So unlike the last decade, 2020 to 2030, which is this decade, may see inflation running high. And as Gurmeet mentioned, inflation causes commodity prices to do well. And within that, silver, for the purposes mentioned earlier in terms of demand supply, and gold, because of the sheer underinvestment in gold, both are likely to probably do well eventually. It's not like there will be a straight line, there cannot be corrections. But as part of asset allocation, they should be a part of investors' asset allocation for diversification benefit. And it's not just silver and gold, arguably copper, aluminum, zinc, and any commodity that you can think of. I mean, because the world is where it is, crude today is at $70. Otherwise, with all the wars happening, crude need not be at 70, but the demand is definitely anemic globally. Yeah. There is a chance of a bounce back eventually when money printing starts in US and of course China also takes some action. At that point of time, you will find these commodities start doing well and probably being invested in them today and keeping space for averaging them lower will ultimately help achieve the objective of creating wealth through commodities as well. Gold and silver both, for different reasons. Gold as a safe haven investment and something people will eventually go back to, right? Other asset classes which you mentioned, like digital currency and all, probably new age or newer generations can understand them better. But the people who have real money and who are probably having it largely in equities today would look to again go back to the safety of gold at some point of time. In universal pension funds don't invest in gold because there's no way to value gold and it's not part of any benchmark indices and they track benchmark indices. But hopefully that will change as we move along and when gold starts to do well. When something doesn't do well for 10, 12 years, obviously people forget it. But last year and this year, I think gold has been one of the better performing, if not the best performing asset class. And 2-3 years of doing that, probably people will rush back into it and we have to position ourselves before the gold rush, so to say.
Yeah. Millennials and boomers with the real money, they would be the one looking at gold and silver like that. Gurmeet, your take on this, the next decade for this asset class?
No, looks positive as been last 3 decades as well. I just pointed out, I think it looks good. And I'm a great believer that the way central banks have printed money, look at the debt US has now, it's about $36 trillion. The interest payment has crossed $1 trillion. That's actually now the third line item in their budget. It's crossed the defense payout. So I think the way this fiat currency will continue to lose some value relatively, and that's where I think if you see central banks across the world are adding gold and will diversify more from dollars. So I'm not saying I'm not in the camp that the de-dollarization as all is happening, but I think there'll be some shift which will happen. We are seeing that. We saw globalization last decade. This decade is more like regional blocks, right? With China, Russia, one block, Europe, not one block, India, mostly non-aligned. And that would lead to a lot of supply chain disruptions, people wanting to be more self-dependent, which in general is positive. And then we are beginning a rate cut cycle now. You will see now more stimulus, China is slowing down, most central banks. We have 4 central bank meetings this week, including the Fed. There is Bank of England, there is Bank of Japan, etc., which also would there'll be some stimulus to revive economies, which again is positive. So I'm very constructive. And as I said, all asset classes don't do well at the same point of time. And I think this is something investors need to learn. Golds essentially will do well when other asset classes don't do well. So, you have to, I would say, you can't remove the last bogey of the train, right? Some asset classes will keep rotating. So I'm saying, I'm including bonds, including commodities. I think they'll make a big comeback, at least for next couple of years, if not the decade.
If everything worked well, it would be an ideal world, right? But we don't live in one. We do take that point. Gurmeet, last question for you. A two-part question. First, a yes or no answer. Should it be a part of anyone's retirement portfolio as well? And second is, what's your pro tip or strategy one should keep in mind while investing in commodity ETFs for our viewers? Something they must do.
So, yes, it should be a part of your overall long-term portfolio for low correlation hedging and the kind of returns it has made. Second, a pro tip, never chase near-term returns. Don't just enter because the last 1 year returns have been very good, because, the returns are very lumpy. You may get a very, sharp return for a period and then nothing may happen and there's been periods where there have been 4, 5 years of returns where gold hasn't done anything. Right? And it's covered up in just 1 year in terms of 5 years of underperformance. So don't enter seeing last 12 months or near-term returns. Mostly, and if you find this too complex, although this is outside the scope of our talk, there's another category which mutual funds have developed. It's called multi-asset, where the fund manager takes a call, how much gold, how much bonds, how much equity, how much silver. And within the fund, when he moves, he doesn't pay tax, because mutual funds are trust and pass-through vehicles. So that's more tax efficient, and you have an expert doing that for you. Maybe that also is an option in case you find this too complex.
Okay, take that point. Chintan, over to you. What do you think is a pro tip viewers should be aware of when investing in commodity ETFs?
So it won't change from the last pro tip that I gave in the part 1 of the show, that do not treat any investment for trade. The longer you can keep the investment, keep it. And of course, the point being that as any asset allocation strategy says, you should have everything in your portfolio based on your risk appetite. So be patient, allow your investments to grow, and of course gold and silver should be a part of your portfolio. And thanks Gurmeet, of course multi-asset funds are something which we love and we've been promoting for a long period of time, but they genuinely are a good solution for investors who are looking at investing across equity, debt, REITs, InvITs, gold, silver, and we are doing it for you on a professional basis. So keep patient, be patient, and enjoy the journey of gold and silver over the decade. Thank you.
Enjoy the investing journey with experts on the show as well. Thank you so much, gentlemen, Gurmeet and Chintan. It was such a pleasure to have both of you on the show today and learn so much. Definitely for our viewers and for me as well. It was a lot of learning today. So thank you for those valuable insights. We hope you've gained a deeper understanding of how to invest in gold and silver through ETFs. Remember, while gold and silver ETFs offer a convenient and cost-effective way to invest in precious metals, it's essential to assess your financial goals, risks, tolerance, and investment horizon before making any decisions, something that Chintan just mentioned. On that note, it's time to wrap up on the show. Thanks for watching and stay tuned for the next masterclass.
ICICI ETF and CNBC-TV18 present Smartly Passive, unlocking the world of ETFs.